Welcome to SilverOak's quarterly webinar. My name is Shannon King, and I am President, Partner, and Chief Compliance Officer of SilverOak. And with me today, as usual, is Jonathan Charlo, also a partner and our lead analyst. This webinar is scheduled for approximately 45 to 60 minutes. As usual, a copy will be posted to the SilverOak website afterwards. If you have any questions throughout the webinar, please feel free to contact your SilverOak advisor after the session ends. If you're not currently working with the SilverOak advisor, feel free to contact me directly at 952-896-5701. And of course, I want to thank Jonathan and John and everybody else on the team that makes the webinar possible. It really does take a full village to do. Including all the folks on the technical side to make it work. For compliance purposes, I must note that we are discussing the overall markets and economy during today's session. And in doing so, we will be providing our interpretations and perspectives. You should not rely upon this information as fact when making any investment decisions. We also will not be discussing specific SilverOak portfolio performance, as each of our clients' portfolios are customized. Nonetheless, our quarterly reports have gone out. Everyone should have received them. And if you haven't heard from your SilverOak advisor yet, and if you have questions, certainly feel free to reach out to us. And of course, since I am the compliance officer, I have to note past performance is no guarantee of future success. So Jonathan, with those housekeeping items taken care of, let's take a look at the agenda and walk us through what we're going to talk about today.
So as usual, we'll go through the economy and the SilverOak dashboard first. We'll then talk about recent market performance trends. We'll give you our outlook. We'll update you on things occurring at SilverOak. And then we're going to review bank and credit union deposit protection. Obviously, that's top of mind with what we've seen in the last 6 weeks in the banking sector.
Yes. And if there are any questions, as I mentioned, feel free to reach out to us. And I neglected to ask, but if there's any topics that clients want to hear about over the next couple of quarters, I just ask that you reach out to your SilverOak advisor and let us know what those topics might be, and we will be sure to try and get them into the sessions over the next quarter or two. So with that, let's start with the economy and the SilverOak dashboard. Hopefully everybody's becoming more familiar with our dashboard. It's broken down into 4 components, and what we're showing here are the quarterly data points for those 4 components. So you can see the economy makes up one of those 4 components, and over the last really couple of quarters, it's been shaded red, which means negative. And the green obviously is positive. If it's gray, it's more neutral. And we still are here in kind of that red category, that negative category, and projected to stay in the negative category for the next quarter as well. Credit markets are another one of the 4 major components. And as with last quarter, that has remained neutral, and we expect will continue to be neutral. Valuations also have remained neutral. But market sentiment, that has actually picked up a bit and went from negative to neutral, and very well could, if the trajectory continues, shift more positive in the next quarter. But overall, the assessment of the composite and the dashboard still is a negative, and we project that to be the case next quarter. Now, we didn't really talk about it in the last couple of sessions, Jonathan, but each of these 4 components are made up of multiple subcomponents And we're going to touch on a few of those subcomponents here in a few minutes.
Yeah, we'll go through one or two of each of the major four sectors, subcomponents.
Good. As we look at the dashboard, kind of trailing in where we are now, you can see to the far right, and I just want to make sure, there we go. To the far right, you're going to see that the trajectory actually flattened out and has started to improve. Obviously, here over the last quarter or two, we saw a big dip in the composite numbers, but that again seems to have kind of found its bottom, and at least we're hoping will now show more positive movement upward. Any specific item, Jonathan, that you'd like to add to that?
Well, yes, it's improving, and we know it's still negative, but as we get more neutral, we should start approaching the threshold lines.
And those are big threshold lines. That red line that goes across, anything above that, it doesn't necessarily mean markets are going up per se, but it is generally more positive environments. Whereas if it's below that threshold line, we generally see a more negative environment. So let's talk about some of the subcomponents.
So here this is part of the economy. So we're looking at the ISM manufacturing index. It tends to be a little bit forward looking, and you'll see on this chart the downward arrow, and we're seeing that number come down, and that's been a pretty long trend in the last year or so. It has broached that red line, which has typically meant once you go below that line, you typically see a recession. And so that's clearly indicating that a recession is likely.
Well, and we were just talking right before we went live here on the session, the S&P released their PMI composite this morning, which has been a little bit more positive than the ISM manufacturing index. Now, who knows exactly which one's accurate, but there is a slight kind of disconnect between some of the economic data.
Yeah, and some manufacturing data that we've seen in the last week or two seems on the margin just a little bit better. Now here we're also looking at the economy. This is something that, you know, for right now is a bit more positive. We do know that when we look at the unemployment rate, when we look at the job openings numbers, things have been, you know, generally very positive. But on this slide, I did want to highlight one thing that is very interesting. And it's the labor force participation rate, which has remained relatively low. But here we're breaking it out, and you're going to look at kind of that dark blue line. That's really the 25 to 54-year-old category.
And this is in the top right quadrant, just in case they didn't see the arrow drop down.
Exactly. And what you're going to see is that it came down quite dramatically during the pandemic, but it's also recovered, and we're now at that kind of pre-pandemic level. The light blue line, though, is the category of 55 and over. And so that fell just as dramatically during the pandemic, but it really hasn't recovered. And so when we hear that there just aren't workers out there available, this is actually one of the reasons why the labor market is so tight.
Well, let's look at kind of the unemployment relative to recessions. So if we see here on this slide, the unemployment rate obviously is quite low. That's at the far, far right. We have the red arrow pointing up only because we would anticipate the unemployment rate to begin to increase, particularly if you're in the camp that at some point later this year early next year we are headed into a recession, if that's your belief, it almost always correlates then with higher unemployment. And you can see that because each of these gray shaded areas on this chart vertically, those are recessions. And you'll see there's a high correlation between the unemployment rate, the black line, peaking during or around those recessionary gray areas. Now let's talk about the economy, not just from a labor market or employment or unemployment perspective. Let's talk about it from a housing perspective.
Yeah, clearly housing numbers are coming down. And that's really a function of how high interest rates have come up in the last year. And we're looking at mortgage rates that are also extremely high, especially relative to where we've been. Now, interestingly, they're not that far different than they were back in 2007, but it's a situation that people aren't really used to those sort of interest rates. And so there's an adjustment period. And so from that standpoint, we're definitely seeing housing starts coming down. And if you look at that year over year green line, that again is a line kind of signifying that from a housing start perspective, it is signaling a coming recession.
But we don't believe it's going to be anything like 2008. Explain why we don't think today is similar to what we saw during the financial crisis.
Yeah, it's really interesting. If we start on the far left, upper quadrant, we're looking at housing inventories. We are near record low levels of inventories, and that's a complete opposite of where we were back during the housing crisis. Then if we look at, one of the things that we've seen this year is relatively high rental rates. But interestingly, because of the mortgage rates being so high, we've actually had a lot of demand for apartments. And so when we look at the vacancy rates among rental properties, it's very, very low. And again, we've kind of talked about the housing starts coming down. But one of the things you probably haven't heard as much is what's going on in the multifamily area. And that's actually been relatively strong. And I think it has to do with the fact that we know that there are between 3 to 5 million units of starter homes that were short. And so as a result, we've seen strong demand for apartments. And so that's where we are seeing building.
Mm-hmm. What about the credit markets? So that's another major component of our dashboard. What are we seeing there?
The yield curve, and in this case, we're measuring the 2-year versus the 10-year treasury. That's inverted, meaning that the 2-year treasury yield is higher than the 10-year. And that's more inverted than it was last quarter. And actually, we're approaching levels of inversion that we haven't seen since the 1980s. And again, this has been a reliable indicator, which suggests that a recession is likely. Now, we've talked about this in the past, and that lag time kind of varies, but many people are kind of thinking second half of this year.
Well, and that gets into what I was going to just ask about, and that is kind of that credit spread and how do we see credit spreads behave during recessionary periods?
Well, if we look at it currently, and that's to the far right, it doesn't really look too bad. But the issue is when you enter a recession, the credit spreads tend to blow out and can go high. In this case, we're looking at high yield or those companies that have more risk, thus they have to pay a higher interest rate. And so with a recession likely coming, we're likely going to see the high yield spread increase. And so for that reason, and we talk about this a little bit later, we favor staying with investment grade fixed income investments.
So higher quality.
Higher quality.
Yeah. Okay. Well, let's talk now about corporate earnings, which everybody by now knows they're just so important, as well as maybe the market sentiment, because market sentiment in the dashboard was the one category that actually improved. But let's start with corporate earnings.
So yeah, from a valuation standpoint, we're kind of at neutral, and corporate earnings have held up fairly well. But we do think, and you're going to see this on the far right, that earnings are starting to come down a bit. And so when we look at the Q1 earnings season so far, in aggregate, it is projected to be down about 6.5%. And for the year, it's still currently projected to be flattish. But again, I think that will come down a little bit. And as we look through the balance of the year, we would think that Q2 will also be down. Maybe that will be the low point, and maybe Q3 comes up a little bit, but is still negative. And then there is that thought that by Q4, we could see earnings kind of back to flat to maybe up slightly. And again, as we look to 2024, the thought at this time is that earnings will be growing slightly at that point.
Yeah, and I think that's great. Great news that hopefully as we enter the new year, things will be improving. There are a few exceptions I should make note of, because you may have even heard one today. P&G came out and they had relatively good earnings. Actually, I think they even maybe increased their expectations for the year. But that's a little bit more isolated with companies that just have pricing power. Certain companies like P&G just seem to have the brand names, and they're able to push along price increases, and consumers, at least yet, have not really balked. But that could change relatively quickly as well.
So the most positive thing on our dashboard is the sentiment. And so interestingly, what we're showing you is the S&P 500, or the market itself. And one of the things that we can glean is that we did have a low point in October, and the markets, through fits and starts, has actually been in an uptrend. And so one of the things we look at is when that green line, which is the 50-day moving average, when that crosses through that orange line, which is the 200-day moving average, that has typically been a bullish situation. But another thing that some people track is how many days the S&P has been trading above the 200-day moving average, following a 20% decline in the prior year. And so we've actually spent a good bit of the last quarter above it. And so that itself is also, from a historical perspective, is bullish. But this is where we also have to say that, you know, past performance is not a guarantee of future success.
Right. Well, and the other thing to point out, and I know we've said it probably on every single webinar session in the past, the economy and the markets are not the same. And up until now, we've been talking a lot about the economy. This is obviously market, sentiment, but we've been talking a lot about the economy, which you've pointed out, most people believe we're likely headed into a recession. That doesn't necessarily mean the stock market's going to perform poorly. And we have a slide in a few minutes to talk about that.
Great point.
So let's talk about what's happened in the markets. So here you'll see Q1, very positive. I think most clients have been surprised by how strong the first quarter of the year has been. And really, if we look back both first and last quarter, first quarter this year, last quarter of 2022, it's been strong. But it hasn't been just one direction. So in the first quarter, just the first quarter, their intra-quarter drawdown, as an example for the S&P 500, was negative 7.5%. So from the high of the market during the quarter, at some point it dropped 7.5%, but still ended the quarter positive 7.5%. So quite a bit of volatility. Obviously, you're going to see small caps had equally as much, if not, more volatility. So it's not been particularly one direction, but it has been overall positive. And this really speaks to trying to not to time the market either, because I mean, trying to trade within these big movements is a very, very difficult thing to do. And I'd say it isn't even investing, right? It's trading, not investing.
Great point.
Here's where I was getting to on Q4 of 2022, and then adding in the first quarter of 23. You can see very strong performance. And then this is looking back from 2019 through 2022. Okay. We have the same information on this slide, but for the fixed income and commodity and REIT areas of the market. And for the most part, at least a common story. I guess the one exception is commodities. Commodities have not done too well this year, nor did they do all that well in the fourth quarter. So let's talk, Jonathan, about style difference, the growth versus value, and which during the quarter did better.
Actually, a surprise for many, it was growth. I think part of that might be that, growth was down so much last year. And that always surprises people that you can go from kind of worst to first in such a short period of time. But that leads to the whole discussion about diversification. But across large, mid, and small, we did see better numbers from the growth side.
And what really drove the growth performance?
It really came down to the industry groups. And so if we look at the first quarter, if you look on the top, you're going to see some negatives, okay, and some small positives. Now, the communication services was up 21%. That's a very, very small industry group. It's Verizon and things like that. The real story, though, is on the bottom half when we're looking at consumer discretionary and technology, which are big economic groups, and they are big groups within growth. And so they had very, very high performance.
Relative to what we're seeing here.
Yeah, and so again, last year when we were looking at 2022, growth underperformed because its two big groups were down a lot. And when you look at value, sure, a couple areas were down quite a bit, but again, those are small industry groups.
So how about small cap versus large cap, the littler companies versus the bigger companies?
Right, so small cap was not up as much in the first quarter as large cap. And again, that had a lot to do with the industries. When we look at technology, it makes up 26% of large cap versus 12% for small cap. And again, when we look at communication services, while that's a bit more value, it is a big sector within the large cap versus the small cap area. And then when we look at, the big areas within small cap, industrials, real estate, they just didn't have the same big performance that you saw from technology.
All right, so we've talked about the growth and value, and we talked about small versus large. How about international relative to the US? How's the international markets done?
International has done better. And if we remember back to last summer, international wasn't doing as well. And I think the average investor just completely hates international, doesn't want to be an international. And so what happened? It kind of had a nice bounce back. Yeah. And so here we're showing, Q1 returns, which were fairly nice. Now, the one in the middle, MSCI BRIC, ups a little bit less, and that had to do with kind of India and China and that kind of region. And surprisingly, I think for many people, is kind of Europe led the way in the first quarter. And here we're going to then add what happened in the fourth quarter on top of that. And again, Europe led the way in the fourth quarter. Now, of course, everything was down last year, and so we're showing kind of the 2022 returns. But again, over the last 2 quarters, we've seen a nice recovery on from the international side.
Well, and even when we look at 2022, like you said, everything was down, and that literally means everything, including the U.S. equity markets were down.
Correct.
So we've talked a lot about equities. We did touch on the credit markets a bit, but what about the bond markets themselves?
Right. So bonds really had a terrible year last year because interest rates came up so quickly and to such a high level, and so returns were negative. But when we look at the first quarter, despite everything going on, we did see rates come down a bit, and so we saw widespread positive performance, and we also saw positive performance within the fourth quarter. Now that was a little bit more variable, but again, you put it together, decent performance from the fixed income side versus, full year being one of the worst years for bonds.
Yes. Well, good. Thank you for walking us through a lot of that market information. Let's talk a little bit now about our outlook. And we're going to start with our economic outlook. In the US, certainly inflation is moderating, but it remains a concern. I think yesterday, don't quote me on this, but I think 6 members of the Fed spoke, and what I've seen or heard is that all 6 had a pretty consistent message, and that is that inflation remains a major concern for them, and maybe they're not quite as concerned about some of the banking issues that we saw a month or so ago. Now, of course, that could change yet this afternoon even, but that was kind of a quasi-consistent message that came out of the Fed speak yesterday. So they are likely to hike at least one more time.
Well, after some of the data we're talking about, maybe they're trying to open the door to another one.
Yes.
That's hard to know. And this changes because when we first started working on the webinar 2 weeks ago, the thought process at that time was they might not actually raise in May.
Right.
And that's clearly shifted.
And I guess to that point, just for folks on the session, what Jonathan is referencing is if the ISM comes in a little stronger, some of the manufacturing starts to pick up, that's all great for the economy in a sense, but that could cause inflationary pressures, which is exactly what the Fed is trying to fight. It's strange where good news can actually be bad news.
Correct. Absolutely.
As we discussed, there is an increasing probability of a mild recession. We don't think anything severe, but we do anticipate likely a mild recession. As it comes to the international economy, again, Jonathan touched on it. Europe has been surprisingly resilient, both from the economic perspective, but also we saw a few slides ago from a market perspective. Now, you put here the magnitude of length of China's stimulus support and kind of post-COVID reopening is uncertain, hopefully positive. Some of the geopolitical issues that are going on maybe not so positive, but that could change in a day as well. We've touched on the recession a couple of times. So what is this chart showing us, Jonathan?
It's a heat map of the variables that the National Bureau of Economic Research looks at in determining whether we're in a recession or not. And if we look, I've got the circle on the far left.
Far right.
Far right, yes, absolutely. We have a lot of yellows, some greens, but some of the greens are turning orange to yellow. And again, meaning we're slipping more towards a recession. And if you look at kind of where we were back in 2020, where you had mostly greens and just a couple yellows, clearly a shift lower. And again, that's why people are thinking a mild recession likely sometime in the second half of the year.
Now, one thing we just briefly touched on, I think it was maybe the first time it was mentioned just a few seconds ago, inflation. Obviously, major concern of the Federal Reserve. So let's touch on what's going on with inflation.
Well, inflation is coming down. Now, it, from the Fed's perspective, isn't at the level they would like it to be, and they probably would like to see it come down a little bit more. And what they're looking at is the core, which is the darker line. That's been a bit more sticky. And there's a lot of debate about that, but likely some of that still is kind of the lingering effects of the supply chain. It is healing, it is getting better, but maybe not fast enough from that perspective. But again, we do think that it will continue to kind of come down, maybe not as fast as people would like. So it will likely remain elevated, through this year and next year.
What I find funny about inflation is it's measured usually, year over year. Once it's gone up, it's not like it goes down, though. I mean, you're just measuring off of a higher base from a month ago or a quarter ago or a year ago. So I always found that kind of interesting.
Right.
Now, we've touched on the banking issue just briefly. It does look like lending is tightening as a result of kind of what happened with SVB and a couple other banks.
Yeah, great point. But they were already doing that. And if anything, it just continues the trend and there's more urgency to it.
I did make note here that I think it was yesterday, or it could have been the day prior, the Federal Reserve's emergency lending program that they instituted for the banks in the wake of SVB and some of the issues that happened over the last 4 to 8 weeks. That lending program actually increased, meaning that more banks in the last week went to get money from the lending program. Not necessarily what you want to see. There's a lot of debate as to why that's happening. Why are banks now going out and getting more from this lending program when it looked like things are settling down? And one theory, I have no idea if it's really true. One theory is that unlike in the Great Recession, when they had some of these programs, there was a stigma about going out and I think they're going to release in 2 years who actually is borrowing from this. But they were concerned when this information got released, maybe there would be a stigma and kind of a backlash. Maybe that's not so much the case today. We're kind of getting used to these emergency programs, which in and of itself is kind of scary. We're getting used to them. Our market outlook as it relates to equities. Contracting liquidity, persistent inflation risk, slowing growth, right? I mean, these all are just items that we've discussed, and they're likely to increase volatility. So we do expect volatility to remain a little bit elevated. U.S. markets, frankly, the equity markets, they think the Fed's going to pivot soon. Whether they do or not, nobody really knows, but I think that's what we're seeing more in the equity markets. Earnings is going to be a big issue. Jonathan talked about that. We do think valuations are more reasonable, but that doesn't mean that, they're screaming buys either. Opportunities are widespread, particularly in the international markets. We still think international markets look attractive. I know we've been saying that for a year or two, probably a little too early because
Doesn't mean that they won't be, though, at
That's
some
true.
point.
That's true. Well, and that's the point of diversification, right? You said from worst to first or first to worst.
Absolutely. You know, we didn't put it on the slide, but another longer term opportunity is still would be small caps. They tend to decline more in recessions, bear markets, but they also tend to perform better in recoveries. And so, you know, that's something we'll have to look at. I do think they got hit because they tend to have more debt and they're not necessarily self-funding. And so with kind of the banking situation, you know, I think they had to be repriced.
Well, a
for
lot
that
of the
risk.
big technology stocks that have, you know, hundreds of millions or billions of dollars of cash, right? I think a lot of people went to them for the safety because they've got, you know, great balance sheets.
Yeah, absolutely. I mean, when you look at the Russell 2000, something like 40% of the companies don't earn any money.
Yes, and the Russell 2000 obviously is a small cap
Yep.
market. Yeah.
Yep.
Well, let's look at prior recessions. And we've shown this chart before. I think it was maybe 2 or 3 webinars prior. This is showing the 9 last recessionary periods. So if you look at the top left, it's 1960 to 1961. At the bottom right is the COVID pandemic recession. And a couple of points to make here. The market, which the market is shown in purple, or excuse me,
Green.
Green. I'm colorblind, so I made a little note here to myself. I got to read my notes correctly. So the market is green. The unemployment rate is purple. The shaded area for each chart is the recession. And the black vertical line is kind of the bottom of the market cycle. And so what we're seeing here is that 2 things. One, typically the market will find a bottom kind of close to the recession or within the recession. Now, sometimes we don't even know we're in a recession.
Well, that's a great point because prior to the late 70s, we didn't have the National Bureau of Economic Research who calls the recessions. And since then, the one thing we note about them is they tend to be a little bit late in calling things. They'll tell you that the recession started 6 months ago.
Yes.
So it's easy to look at on a chart like this, but when you're actually in the situation, there are more unknowns.
Yeah. And like you said, typically they are late. And I think their delay in saying we're out of recession is even worse.
Well, right, because the COVID 1 month recession, they didn't tell us until I think December that we were out of it.
Yeah.
So
Yeah, it's very, very good point. But on the chart, you'll see we tend to hit bottoms during recessions. But the important thing is, I mentioned earlier, the economy is not the markets, and vice versa. The markets aren't the economy. So the markets will tend to react in advance of the economy. So as we look at, let's say, the top right box, the 1960 to 1961 recession.
top left.
Or excuse me, I did what you did,
Yep.
opposite, the top left. The top left box. The green line, again, representing the stock market, hit the bottom where the black vertical line intersects, and it started to improve. The purple line at the same time started going up, but that's not good. That's unemployment going up. So the market is improving at the same time unemployment is worsening. It's kind of counterintuitive to a lot of folks. I really want to stress this though, because later this year, if we do go into a recession, don't be surprised. You'll see on the nightly news or, you know, see on your favorite news feed that unemployment's getting worse. Don't correlate that to the stock market necessarily is getting worse. Very well may not be the case. Actually, during recessions, markets don't perform nearly as poorly as some people expect. So walk us through this, Jonathan.
So going back to 1972, the average recession performance for long-term bonds is 10%, and for intermediate term bonds, so kind of thinking that 10 to 15 years, is 9.3%. Now stocks, on the other hand, are negative. Maybe not as negative as people think, but nevertheless, the average is negative 2.1%.
However,
that negative return is being heavily influenced by the 08-09 bear market, where it was down 25% in that recession. Now, conversely, that high bond return is also being influenced by the bond return back in 81-82, where it was up 34%. You take those two big years out, you're looking at stock returns that are probably flattish to maybe up just a little bit, and bond returns that, while still very good, might be in that 5 to 6% range.
So one thing we always advise is not to get too bearish, especially over short terms and quarters, and even a year, 2 years isn't really all that long of a period in the markets. But here, what we're looking at is prior S&P 500 down years, in which the first quarter of the following year was positive. Is that right?
That's correct.
And what do we see?
What we then see is, if we look at the next three columns, you're looking out, what happens in April? Well, April was typically up. What happens in the second quarter? That's a little bit more mixed. We have a couple down periods, but mostly up. But then when you go out and measure the rest of the year at year end, we're looking at positive performance. And that's kind of hard to believe when you're looking at all the economic data. But this is, again, where you've been talking about the economy and the markets are not the same thing. And the market ultimately is the leading indicator, suggesting that by year end, we'll probably be up. Now, we also know in the pandemic, we made history.
Right.
So this isn't a guarantee,
right,
but gives us a good idea. And that doesn't mean that we can't see volatility over the summer and the next quarter or two, and even a pullback in the markets as the economy worsens, as earnings come down.
Sure. But just like the first quarter, we saw, those first quarter, intra-quarter drawdowns, pretty significant, yet the quarter still ended positive.
Right. Absolutely. So it's probably going to be one of those things, again, if it does end up being positive at year end, it's not going to be going straight up.
Right. Now, we talked about international performance. Some of that was driven off of currency. So talk to us about what's happened in the currency markets.
Yeah, so we've talked about this, but never really gone into great detail in a webinar. So here we're looking at the US dollar index against a basket of foreign currencies. When the dollar index is going up, that means that the dollar is appreciating. That's actually not good for international equities. And in fact, if we look at the low point in the dollar index back in July of 2011, up until the peak in October of 2022, international returns on a relative basis to US returns were a negative 225%. That's a huge gap.
Just from currency.
Just from currency.
The opposite happens then, and that's kind of what we've seen since October, is the dollar drop.
Right, and so as a result, so far, we've seen a 12% outperformance.
Interesting. Just from currency moves. Well, and this chart has amazed me the last year or two, because on this chart, what we're seeing is in gray, we have US outperformance. and the x-axis is years. So the longer the gray lasts, that's the duration of US outperforming. And then the magnitude is on the y-axis as to how much US maybe did outperform international. The other color, and
Purple.
okay, thank you. Let you decide. I was going to say brown, so I'm glad I did. That's international outperformance. So it has been a long time since we've seen international, and that's probably why you made the comment earlier that a lot of investors were just ready to be done completely with international stocks.
Right. When you also think about it, if you're younger in your 20s, you haven't actually ever experienced international outperformance.
Yes.
So.
Yes. So finally, we've seen that gray area stop. And whether we're going to see international, to the magnitude that it has outperformed in prior periods, we don't know. But we are still very optimistic and believe people should have that international exposure in their portfolios. So as our outlook goes on, let's talk a little bit about bonds. We've talked that interest rates have gone up. That makes yields more attractive, right? We want to stay in the higher quality. You mentioned that a couple of times. We don't want to take a lot of credit risk. We don't want to be too short in duration either, though. We're going to talk about cash. That cash is like super short. We don't want to be too short in duration, especially for investable assets. Cash is great for liquidity, but not for investing. What else would you want to point out on this outlook, Jonathan? Anything?
Yeah, we're going to actually show you why you shouldn't be too short in duration on the next slide.
Perfect timing.
So here we're looking at different periods where we saw a peak in 6-month CD rates, and that's really the brown on the left of each of the clusters. And what you'll then see is that in the next 12 months, you see kind of what US Treasuries, other investment grade, or high yield. And you're going to see that generally those rates are higher. And so when you think about it, if you were to go out and buy, say, a 6-month CD, you might get a higher rate than, say, because the yield curve is inverted, than, say, a 5-year or 6-year sort of investment. But what happens when you have to roll that in 6 months? If rates are lower at that point, then your reinvestment will be at that lower rate. Whereas if you bought that longer bond, you still have that interest rate, but you might also have a little price appreciation. And so this is showing total return.
Good point. And of course, municipals, I think I actually neglected to mention it, but municipals are quite attractive right now.
Yeah, absolutely. So here we're showing that gap between the yield on a treasury versus the taxable equivalent yield. So again, the actual yield that the municipal bond is lower, but when you take the fact that you're not paying federal and in many cases state income taxes on it, your tax equivalent yield is very, very high. So on a 20-year, which maybe a lot of people wouldn't know, is 6% roughly, but kind of within that 10 to 20-year period in terms of that duration, you still have very, very kind of attractive yields, and that's where that kind of left arrow that you're seeing is.
And there are slight differences in credit, right? I mean, U.S. Treasury's the safest instrument theoretically on earth, at least to the extent you believe the U.S. government will back those securities. Whereas munis, I wouldn't say high, at least for most of them generally, not high credit risk, but higher than the government.
Sure, and there certainly are some municipalities and states that have some issues.
Yeah.
But because of the pandemic and the support, generally they're sitting on cash. They're not really funding a lot of new projects yet. Maybe some people would argue that's a problem,
right?
But you still have very high demand because of that tax break.
Sure. Well, let's just briefly touch on the 60-40 portfolio. And I only bring this one up because 2022 was the third worst year since 1952 for a 60-40 portfolio, 60% equities, 40% bonds. And most of that was driven off of equities were down, bonds were down. I mean, it was a tough year all around. But we believed then, and we continue to believe, that the bond market wasn't or isn't going to be down forever. And that diversification across this is important based on each investor's risk profile. Now, not all investors should be in a 60-40. Some maybe no bonds, others 80-20 or 50-50. But we're just using the 60-40 as an example. So again, we had a nice rebound. The thing not to do, though, is we did have some investors, and I wouldn't say our clients, but we just generally know, in the marketplace, some people were looking at their 40% bond portfolios and saying, well, geez, maybe I should sell those bonds, right? And buy T-bills or some other cash equivalent to lock in that higher interest rate. But to your point, they weren't thinking about the reinvestment risk, because cash or those short-term investments, they are not long-term strategies. Now, it doesn't mean that we don't like cash. We do like cash. As a matter of fact, 2022 is a prime example is why we like cash. Because we don't want our clients to have to sell when investments are down. So we try to keep a bucket of cash. We have a 3-bucket approach. We first fill the cash bucket worth basically the value of 12 to 24 months of cash flow needs. So whatever you might need over the next 12 to 24 months, that is held in a cash management portfolio. But then the rest of your portfolio remains in a diversified equity or bond approach. All right, with that, let's go through a couple of SilverOak updates. 2022 tax season's over, at least you put here.
For most people, unless you've extended.
Exactly. Exactly. It's nice to have tax season over, at least for most. It's great. Our IQs, give us an update on what is going on with performance.
We've talked about international and how it's improved in the last 6 months. And so our international funds have done, very well on an absolute basis as well as on a relative basis. And then also we talked about growth, and honestly, our growth funds have had a good 6-month period as well. When we look at kind of our fixed income bucket, we're seeing, of course, better absolute returns and generally fairly good relative performance as well.
I think the one category, to be fully transparent, is our value may be a little bit soft after coming off of some pretty strong relative performance.
Yeah, that's been kind of mixed.
Yeah.
We've seen a handful doing fairly well, but I would say generally, again, absolute returns lower, but relative returns in some cases a little bit strained.
And we certainly have a couple that have done quite well, but just kind of in general, maybe more strained. As far as personnel updates, we are still looking to fill an executive assistant and administrative assistant role. So that's been a challenge. We talked about the job market earlier. We are filling the challenge of the job market with unemployment being so low. And we have a couple of projects on technology enhancements going on, not fully implemented, but hopefully will be by mid-year or shortly thereafter. One's our CRM software, and the other is our trading software. So super excited about those. Now, Jonathan, we're going to wrap up today's discussion with deposit protection, because as you mentioned at the start of our discussion, this is a big issue as a result of Silicon Valley Bank going under, et cetera. So why don't you walk us through what is FDIC and what do depositors need to know about it?
Yeah, so one big picture item is if you do banking at an FDIC insured bank, which most are, you don't have to do anything. It is automatic. And the other thing I'll cover is we're calling this FDIC, but this also pertains to credit unions, and that is protected through the National Credit Union Association. But it basically covers more demand accounts. So checking and savings accounts, money market, deposit accounts, CDs, cashier's checks, money orders. But it doesn't cover more things that are investments, stocks, bonds, mutual funds, ETFs, doesn't cover life insurance policies or annuities, doesn't cover municipal bond securities, treasuries, and also safe deposit boxes.
Good point. So what are the limits on coverage? Because over the years, this has changed.
It's generally thought that it's $250,000 per owner. So single account, one owner, 250. Now with the joint account, there's two owners, so it's still 250 per owner, or in this case 500. Retirement accounts, 250,000. Employee benefit plan accounts, 250. Revocable trusts, 250,000. And you're going to see unique beneficiary. We'll kind of get into that as well.
So let's walk through an example of this coverage.
So here we're looking at an individual account, Marcy Jones. She has a money market deposit account, 15,000, 20,000 in savings, 200,000 in her CD, and then sole proprietorship checking account with 25,000 for a total of 260,000. She's one person, so it's covered by 250. So she is technically uninsured for $10,000.
What could she do if she wanted to change that?
Well, one of the things she could do is she could add a person and have a joint account.
Okay.
She could open another bank account at another FDIC insured bank. She could open a trust account and then add beneficiaries.
Yeah. Or the other one is just simply add beneficiaries to this account.
That's true. Yeah.
It's kind of a unique and it's a very small print under the FDIC website, but they do know that if the owner of a single account has designated one or more beneficiaries who will receive the deposit, when the account owner dies, the account would be insured as a revocable trust, getting back to that trust. So almost like making it a trust without even having to change it. Here's another example. So walk us through this one.
So here we have John Jones has 3 trust accounts with different investments. And you'll see that he has the same 2 beneficiaries, Jack and Janet. So the way the FDIC looks at it is the maximum insurance coverage for these 3 accounts is calculated as one owner times 2 beneficiaries, which would equal 500,000. So John, in this case, is fully insured.
Excellent.
Now, the other point I'll make is that you can add up to 5 beneficiaries. And so that coverage would then be $1,250,000.
Good point. And if anybody's looking for a beneficiary to add, you might not have a beneficiary. You can just, I gave out my number.
Oh, okay.
I'm a good beneficiary.
Yeah, I think Tricia might be interested too.
Oh, we might have a few members that are interested in that. Obviously, just kidding there. Well, let's talk about brokerage account protections because FDIC is bank. And you mentioned the institution that covers credit unions. But what about brokerage accounts? And as it relates to brokerage accounts, this is SIPC protection. So before we get into SIPC, the first note to make, though, is that clients' assets at brokerage accounts are segregated from the assets of the brokerage firm itself. So there is a protection there that if there is a brokerage firm that has financial challenges, that clients' assets are segregated from that firm's assets. And that is a requirement under the SEC's consumer protection rule. SIPC still is available, though. It protects against loss from financially troubled member firms or from the custody function of broker-dealers. It is limited, $500,000, including $250,000 of cash. But again, the really important thing that's changed over the years is that clients' assets are segregated and not commingled with those of the firm. Now, what even SIPC doesn't protect against is a decline in the value of your securities, i.e., just bad investment decisions. Obviously, there's no insurance against that, at least that I'm aware of. And commodities and currency investments are not considered part of what would be covered under SIPC. And of course, brokerage firms across the board all have additional levels of insurance to protect against just bad behavior within the organization. If there's a rogue employee that does something and somehow circumvents all of the procedures to prevent something bad happening, they have insurance policies to help back that up. So with that, we're going to end today's discussion, but I would suggest and certainly encourage, if you have any questions, reach out to us, or if you have any topics that you would like us to cover in one of our future sessions. If you're not working with the SilverOak advisor and you want to reach out, you can call me at 952-896-5701. Otherwise, again, thank you, Jonathan, and thank you for the rest of the team, and hope everybody has a great day.
Thank you, everyone.